All right, give people a moment to
And they're off.
get in here. Oh my goodness. Good morning, everyone. Welcome. Sorry, we're starting a little late. We're having the usual technical difficulties.
Shout out to the Bay Area. I saw like North Bay, South Bay, Peninsula. I saw these emails, OC Camp. Pretty cool.
Yeah.
You guys are promoting the heck out of this thing.
Yeah, they're doing, yeah, we have a few chapters who are really great. Good morning, Heidi. Good morning, everyone. Thank you for being here this day after 4th of July. We know that you just got a working link like 30 seconds ago. So we're always, we're working on, Kevin, we've done this transition. It's been quite the adventure, and we are, we're getting close to having it together. Not quite there yet. So here we are on this lovely July 5th. We want to say welcome to Kevin Peranio, PRMG. Kevin, are you an American?
I could not have worn a more obnoxious Americana shirt on July 5th. You'll be happy to know I bought this in I think it was downtown Pleasanton. Actually, there's like a cow Western wear shop in there, and this is legit like a rodeo roping cowboy cowgirl shirt. I think it's more cowboy. So yeah, I didn't wear it yesterday, but I'm wearing it today for you.
Well, gosh, thank you, Kevin. Thank you so much. And then we have Kevin Casey, who's live from London.
Yeah.
Welcome, Kevin. How are you?
Yeah, live from London. Well, you know what? And they don't have a 4th of July holiday here yesterday. I was like bewildered why they weren't all off from holidays.
Yeah, it's confusing. You should have asked for some tea, and then they would have told you it had all been dumped into a harbor, and that's why they don't celebrate 4th of July. So welcome, everyone. Welcome. It is, I gotta tell you, I cannot believe how many people are here today. Thank you, everyone. We love you so much. They're so wonderful. They have followed us. They have made it through a few different iterations, and we're promising that we are going to have our acts together very soon. Trying to figure out a system that works is challenging, and it has definitely been challenging. I will tell you that. Okay.
Yeah, I have no idea what that is.
Oh yes, we got a bot.
What does that mean?
I don't know. We got a bot. We did pee-poo to everyone. So whoever pee-poo is, it's registered. They're typing fast and putting in some messages. That's
wow.
You made it on social media when you have randomness like that going on.
All right. Well, apparently there was
Social bot.
There was a Tony Robbins webinar recently for an event, and apparently there was porn being played on it. So I feel very grateful that is not what we are looking at right now. So yay. Anyway, good to know that something about the laws of aviation, and I'm like, okay, anyway, good Lord. Okay, so we will deal with that later.
Ignore that for now. Yeah.
So somebody said it's my spam script. It works great. All right. So good morning. Let's get this thing rolling, shall we? Good grief. All right. So as usual, always a million things going on in the news, and let's start with fourth quarter GDP. So the estimate was that it was down 1.5%. We have now learned, because we're learning a lot about GDP and recessions, et cetera, that we have to wait, because there are 3 different steps on, they give you the estimate GDP, and then you get, like 3 months later, you get final. So we went from 1.5% was the estimate that we were negative, and the final was 1.6%. Okay. So here's another funny thing. So we have always been schooled that the definition of a recession is 2 consecutive quarters of GDP. And now what we are learning is that is not entirely the case. So guess who makes the call on whether we're in a recession or not? I bet you know, Kevin Peranio.
Yeah, it's like some economic forum that just like made up these rules. They change the goalposts as you go.
Exactly. Well, they make it look so it's not so bad. And I think they're trying not to freak everyone out. So it's funny, I wrote down the names because I knew I wouldn't remember it. So National Board of Economic Research, NBER. That's the acronym, NBER. Kevin always accuses me of not explaining what the acronyms mean, and I'm trying to be better about it. So NBER, National Board of Economic Research. Yes, folks, there will be a test at the end. So it is, okay, I also wrote down what their different requirements
Yeah,
are. Okay,
it's like, do you feel like you're in recession? Okay, that's it. You're good.
okay, yeah, so it is very arbitrary. Okay, so it is a significant, okay, so -2/4 of decline in GDP. Yeah, that's the thing, okay? But it's not all of it, or even, it doesn't even necessarily have to be the case. Significant decline in economic activity that is spread across the economy and lasts more than a few months. I mean, does that seem like incredibly vague to you? Because it does to me.
Totally.
Okay,
Yes.
there's 3 components of that. You ready? Gina, you're back if you're interested in that. Okay, so we have 1, 2, 3. We have depth, diffusion, duration. So depth, how much of the economy is contracting, and diffusion, how it is spread, how widespread it is, and then duration, obviously how long, right? So little of all 3, but can be one super significance, right? So when are we going to get into final Q2 readings? Into September.
Isn't that great? So that's why they always say that you never really know you're in one until
it's
you know
over.
6 months later. You look back and you're like, oh, the reports came out. And by the way, they do revisions all the time, like you just pointed out.
Yep.
Jobs reports too. We got a jobs report coming up Friday, so they always revise old ones too. And so then they're like,
Yeah.
oh, you felt kind of like, defeated a little bit, but let me just remind you that the reports, the last 2 ones, are even worse than we told you.
Exactly.
So then you feel even more defeated. So then it's like a self-fulfilling prophecy, and it just feeds on yourself. And then everyone just talks about recession. And next thing you know, you're like, man, I guess we're in a recession. This sucks. So I'm just not going to do anything. So, but all kidding aside.
Although you're probably out of it by then.
Yeah.
Well, we certainly were in and out quicker than we could blink in 2020. We'll see what this next one looks like. So like Kevin was saying, ADP is going to be Thursday this week. They pushed it because of the holiday. And then we have BLS on Friday. So Thursday's ADP report is supposed to be 200,000 jobs created. And then Friday is BLS. They're expecting 300,000, and that the unemployment rate will stay at 3.6. We also have Fed minute meetings being released tomorrow. So these are market movers, people. So make sure that you're paying attention. And if you see a rate you like, lock it in. But
that's right.
Because we've had such a huge swing since the Fed raised 75 basis points and rates are significantly better, I'm curious to see what's starting, like I'm starting to think about my locks, like, do I need to look at them? Are they that much better? Because maybe, right?
Yeah. I mean, the bond market's rallied today. I mean,
it's been rallying 4 days, not just 2 days.
If you want to use the 10-year as kind of the barometer, even though it's not like direct correlation to mortgage rates, it's pretty good. It peaked at 348 on the yield, and it's come down to like 280. I think this morning it was even less than that. I've got some text alerts in there as well.
Yeah.
I mean, that's a massive swing in a short amount of time, and just basically 10 trading sessions, 2 weeks, if you will.
Yeah.
So they say the bond traders are the smartest people on Wall Street, and they're pricing in a recession. I mean, they're actually maybe a little bit ahead of maybe the stock market, if you will. So they're, when you see yields come down like that, it's macro headwinds, a lot less growth, recessionary type stuff, and they're pricing that in. And so, should we be changing if you see a rate lock it in? Should we start to float? Should we start to cautiously float? There's definitely some movement going on in the market to make you think, rates are getting a little better. I mean, clearly they are, in the short term. So
the Atlanta Fed came out and revised their estimates for Q2 down to negative finally, which
they were under 2, then went to 0. Now they're negative.
Yeah, isn't that something? So, and I find it interesting because it was one of the things I wanted to talk about today. So long locks, right? I just saw a company that's advertising that they have come out, a fintech company, that they're coming out with a 120-day lock. I can see where it's a company it's a startup called Tomo, Tomo. And they're saying, well, we can do this because we're not selling on the secondary market like other people are, because of course you got some, investors that are like, just do whatever you want, it's fine. So anyway, my question is, how important are these long locks if you're not a builder? Because me as an originator on the street, not working for a builder, I don't need 120-day locks, and they got to be super expensive, right? I mean,
Yeah.
are you seeing a real need for this?
Yeah, I think new construction is definitely the key.
That's
I mean,
it.
that's where it's at. Some we allow for locks on TBD properties at PRMG, so you can, maybe your bar is out shopping and hunting for a home and they haven't gotten under contract yet. Those are things that you can do as well. But you talk about duration. I mean, it's a dangerous game to play. Fannie, Freddie, Ginnie loans are typically traded and backed by, mortgage-backed securities in the secondary market. And the further out you go, the more risk there is that, your rate, rates will get better or worse. They could go either way. So, we have a 120-day lock. We've allowed it, for quite some time, plus 2 30-day extensions beyond that.
Holy smokes.
Oh, wow.
And
yeah.
okay, do you have any sense of how many of those close? I mean, is it a big percentage?
Yeah, it's about 65%. So
Wow.
our normal locks that are 45 days and under, well, let's start with 30 day. 30-day, it's about 83%. And then when rates get worse in the market, that number floats up to around 90. 45-day locks typically are at about 80%, and they float up to mid 80s. So, the longer the duration, the more chance it falls out, regardless of what's going on with the rate or the property or whatever. So anyway, your best bet's typically, 30-day locks or less. You got some under contract and get rolling, and then everyone's happy. You just make it work. But it's extraordinary time. I mean, look at how it's like the quickest rates have ever risen in like a 3, 4, 5 month period in like our industry's history.
Yeah.
But it could go back the other way. I mean, look what just happened. We talk about the 10-year going back from 348 down to 280.
Right.
I mean, it could go back the other way, and rates could improve very drastically if there's serious fears of a recession and they become a reality.
Okay, let's just take a moment with that being said and remind people, do not get too excited. I mean, you know how volatile this market has been. Do not assume that is what is happening. Assume it's still going to continue to be a cluster and that it's going to be volatile, and just be careful. I'm just cautioning you, be careful. We are in uncharted waters on a number of different fronts. And I just want to make sure that we don't, get overcome with the euphoria of the moment, because we're getting a little breath of fresh air for the first time in 2022, as far as I am concerned. And yes, it's great. Yes, it's positive, but be careful. Just be careful. And I also want to take a moment because I read it somewhere.
So Kevin, you might have a feel for this. Did you catch me?
Yes,
That was a
live
big
from
delay on
England.
that.
Go ahead.
Live
all the way from
England.
London.
I just have
Yeah.
a report from England here.
Go.
Knows about my obsession about tower cranes and how they affect the economy. Well, I was in Dublin last week, 30 tower cranes all over Dublin. London's got 20 plus easily, and I wasn't able to count them as well as I was in Dublin. In Dublin, I was able to go up to the Guinness brewery and have a big skyscraper on top. It looks like a big Guinness glass, and you can see the whole downtown all around in Dublin. So I was able to literally count all the tower cranes.
Okay, first of all, I'm just going to say I'm not entirely convinced that
London,
Kevin,
just pulling
after
into London, I was able to count as I went by 20. So
Kevin,
Hey, I like the tower crane theory. I lived in South Florida for 13 years, and I watched them all go up in Miami and Fort Lauderdale, even a little bit in Palm Beach County, Broward County was Fort Lauderdale, and I mean, it was a telltale sign that the impending doom was coming. But with the Champlain Towers collapse and the stringent condo guidelines, it's gotten harder to create that product. But having said that, I like that theory. I mean, I'm with you. I think the more you see them go up, people kind of get caught flat-footed when the economy turns back so abruptly the other way.
Okay, I don't think that we should be judging economic activity in Dublin, Ireland, unless we have clarified that Kevin counted the tower cranes before the Guinness tour and not after. because if he's counting them after, I am not convinced there were 30. There could have been 15 and he's just seen double. So which one, Kevin, did you count them before or after the tour? Yeah.
Okay, my tour included one glass of Guinness. So
please.
no, I was perfectly fine there.
Please. That's like I was telling these guys that I just got
And you know how
back.
hard it is to get drunk on Guinness?
No, I do not. I was telling them that I just got back from Cancun late last night, and I do have many memories of having one shot in each hand all the time. And so I'm like, my body today is just going into withdrawals. I think I'm like, okay, I haven't had a shot. It is, there's no sun and it's bizarre. So anyway, I'm glad. I mean, it's good. I hope that in those beautiful cities that they are using those tower cranes to repair the gorgeous buildings that they already have and not build new ugly ones after they knocked over some gorgeous historical thing like in Berlin. Anyway, if you love Berlin, don't, I'm sorry. Okay. So anyway, and Tom wants to know, Kevin, is Guinness a business expense if you're counting tower cranes? I think so. I'm going to go with yes. What do you think? We're going to vote.
Absolutely.
Yeah,
I would agree.
that was a business expense. You're doing a
R&D,
Yep.
R&D. And in fact, if you were doing
Doing research. Absolutely.
And if you were doing R&D on behalf of your business that's based in the state of California and there was any technology involved, you actually can get an R&D technology tax credit. So you should look into that.
Okay, we're going to consult later, Kevin, because I would like you to help me figure out how to deduct my Cancun week. That'd be awesome. I found it interesting. I read that 13% of finance cars most recently have $1,000 or more a month payment. 13%. That's up from 7% in 2021. And I think that going forward, especially headed into a recession, that is going to impact people's ability to buy other things, right? And since consumer spending is 7% or 70% of GDP, that's going to have an impact, right, Kevin? KP?
Yeah. I apologize for those that are into cars. I'm not into cars. For me, they're just a means of transportation.
I am surprised.
I get from A to B. Clearly, I'm not flashy. I don't know. I just feel like it's a depreciating asset. It's a waste of money. Like to me, it's just from A to B. That's it. And so
you have 17 children. You probably drive a minivan, which is just sad and embarrassing for you. But whatever.
I pushed hard. In Thanksgiving in 2018, I pushed hard for the minivan, and with GM, my in-laws, they all design cars for GM, and they're from the Detroit area. So we got like this killer discount. So it's like Suburban, Yukon, or Escalade. So we settled for the middle ground, the Yukon XLT, the large one, like totally decked out. The dealership would not let us leave. They're like, we are losing money on this vehicle because they're discount. They tried to get us to finance. They tried to get us to use their terms. Of course, I use my credit union, which is amazing. So I think that, when you talk about cracks in credit and how that could feed into a recession, consumers are burning through their savings, and then now we're watching these jobs reports that are coming out later this week. The weekly jobless claims, by the way, in addition to the ADP and the Bureau of Labor Statistics, but then there's the jobs report, job opening and losses, right? So are there still 11 million jobs open, or are there less jobs open out there? So all those things, in addition to credit defaulting, right? Are people gonna not make those $1,000 payments? Are they not gonna be able to make their housing payment? People don't talk about taxes going up. I mean, taxes and insurance going up with all this record home price appreciation. Home prices are going up for people that got into a house 2 years ago. And can they afford those payments?
Okay, Kevin Peranio. Somebody was talking about that. Guess who that was? Months ago.
Me, you, us.
Yes, us.
Yes.
I was like, okay, if you've got values around the country going up 20 to 30%, you don't have Prop 13 or something like it, like we do in California, limiting at least, how are those people going to be doing? And then at first I was told, oh, it's fine. Don't worry. Everything's fine. And now we're starting to hear that it is not fine. Like when people start getting those property tax bills, it's going to be a shock and it's going to be an issue. And so it's going to be interesting how governments and, local governments, et cetera, how are they going to deal with that?
So somewhere, every underwriter that ever questioned the taxes on your new home construction, like, come on, just let me use the land only taxes. That'll be fine. That'll be their problem later after closing. Somewhere, every one of those underwriters are smiling and with the "I told you so" look, and they look, it's a real risk. I mean, you can only afford what you can afford. But I think at the end of the day, people are going to shed the car payment. They're going to shed the credit card payment. They're going to take less trips. They're going to trade down from Whole Foods down to maybe some Costco. Maybe they're going to go to Dollar General, TJ Maxx, Marshalls. They're going to trade down from all these different areas before they stop making the housing payment. And
let's hope it doesn't come to that, Kevin. But yeah, I agree.
Hey, you never know. The depth part of the recession is another uncertainty. Although most people think it's going to be a mild recession.
Okay, this week in Mexico, I was talking to some people from Texas, and they were telling me what their property tax rates were. So in California, we use 1.25% of the purchase price as, just a baseline. And yeah, no, it was like over 3%.
Yeah.
And so, okay, let's say you bought a house for $1 million, $1.2 million, and now it's worth $2 million. The when I was running the math, you should have seen me, 16 shots in, and I've got my little iPhone going, what's 3.78% of $2 million? $76,000 a year in property taxes.
So I'm from Texas, born and raised Texas. I started in the industry in 2001 as a wholesale EE for First Magnus in Austin, and for a couple of years. And so, yeah, a lot of the areas, it's anywhere from 2.2 to 3%. But remember, California is different. When you buy the home, what you paid for the home at that moment, that's your taxable amount. Florida, Texas, a lot of places around the country, they have an appraisal authority where they assess the value, right? And they try and assess what your value is. And it's always way under what you pay for it. And then you can fight it. They're great, by the way, they're great services. You see those little flyers in the mail. I think one's called Paramount Tax Service. I use that on all my properties that I've never sold a property. I keep them all rented out. They go fight the values. They actually get me literally thousands of dollars of tax savings a year on those properties. So there's what you pay, there's what's assessed, and then there's the rate you're assessed at. So it's not like, because a new person sold their house in California and moved to Texas and paid twice what you paid for it, then now you're taxed at that rate. There is like a process there that you can fight, but it is a much higher rate in Texas, sometimes as much as 3%. And of course you get a lot more house and land for your money there. So there's a trade-off, but I agree. It's a big deal. It's a silent killer, just like inflation is a silent killer.
Well, these people live just outside of Houston, and they were saying they were at 3.78%, and that they had bought way below their means, but that a lot of people had not. So again, I think this is going to be an evolving conversation, and it will be very interesting to see how it plays out. But it's something that we need to be helping our clients with. Okay, be prepared for this. And also, all these people who are thinking, oh, I'm moving out of the state, I'm moving here, I'm moving there, wherever it is in the country, you need to understand how they don't have state tax, but they're going to absolutely sock it to you on property taxes or sales tax or whatever it is, right?
Yeah. Sales tax. I mean, sales tax is not cheap in those states. I mean, Kevin's over there paying reparations for his tea taxes that he didn't pay.
But they have no tax here.
That's true.
If something says $5, you pay $5, no sales tax.
Yeah, well, if you're paying dollars and they're taking it over pounds, good for you.
Well, pounds, yeah. No, it's pounds, but
pound of flesh.
Yeah. So anyway, so it'll be interesting to see. They're expecting initial jobless claims, and that is a recession indicator too. So, and if you listen to Barry Habib and his crew, they believe that initial jobless claims hit a bottom and then start going up, and that upward trend is where the is the recession indicator. And so this week will be very telling. They think we're probably there because although the latest jobless claims that we just had were flat, the 4-week moving average is going up. So that could be happening as we speak and already be in motion. Okay, so someone was saying that they sold their 2018 Prius, which they had bought in 2019, they made $7,000 on it, which is crazy on a used car, right? Or when you're selling a used car. I bought and by the way, oh, Jill, it's Jill. I believe personally that it should be against the law to drive a Prius in the fast lane. And so if they sold their Prius, you are now allowed to drive in the fast lane with your car that may not be a Prius.
Is it?
I'll be in the fast lane behind one going, okay, why are you here? Why?
They have what's called the Mannheim car index, and Mannheim is there's two really big data aggregators in the car business, and you can watch the price of used cars. They peaked last year and they've been coming down. They're still higher than pre-pandemic, but we've seen that come down. We've seen obviously lumber come down, but we've talked about lumber costs in the past. So things are higher than they were pre-pandemic, but they've come down from their peak. Even oil has retreated from its $120 a barrel price. And so a lot of kind of these things are all interconnected. You see the bond market going from 348 on 10-year down, below 3. There's a lot of people that think that we've seen peak inflation. So that just means that inflation is not growing at this crazy amount, but it's still elevated and it's coming down slightly. Right. And so the duration part is the part that we're keeping an eye on. I mean, is it going to come down before the year is up or into next year and continue to eat away at our purchasing power? Thank God the dollar is as strong as it is, as you and Kevin have both noticed in your foreign travels.
Yeah. Well, honestly, it's a little difficult to tell when you're at a very nice resort in Cancun and you pay $35 or $38 for a bottle of sunscreen because you didn't know how to convert pesos and didn't realize that, your meals are included, but you're going to get hosed if you need to not get a sunburn. So anyway, so PCE is interesting because, again, Fed's favorite measure of inflation, right? So these numbers are definitely moderating a little bit, right? Just a little bit.
It's not real inflation, right? It's kind of basically like you see CPI and PPI, and this is kind of a combination of the two, and that's what the Fed likes to use. But
there's no housing in it, right?
Well, there is. I think it's like 22% or something. Okay. It's actually a pretty big component of it. But it's not as big of a percentage of what housing really is for most people, and it's not capturing the fact that rent is still going up and astronomically high. And so, if you Google like real inflation numbers, there's this whole debate online of like, the Fed's kind of using this fake number to go, it's not as bad, or at least to call it transitory. I mean, it's pretty bad out there. And so then it starts to get you into sentiment, which, love or hate the Michigan, consumer sentiment report. I mean, it's like the one that's used by everybody. And I did a LinkedIn video yesterday. I was talking about, a lot of people feel bad out there. At least yesterday for a day, we can feel good, about our country and where we are. And, and then the other 51 weeks of the year, we can go back to, feeling like crap potentially. But what was interesting is Kathy Wood of ARK Invest, her and her data team, they're absolutely fantastic. Whether you believe with her 3 to 5 year investment horizon on tech and fintech, she does break down the data that's out there in a very experienced and digestible manner. The Michigan consumer sentiment, people who are white collar workers had a worse sentiment on the economy and what's going on than the lower end wage earners. And I thought that was very telling because, a lot of times, the big spenders out there, the white collar spenders, they're the ones that kind of keep that GDP afloat, that 70% of consumer spending afloat. And they have a worse outlook, according to the Michigan Consumer Sentiment Report, than the lower end wage earners, which is crazy because the lower end are the ones that get hurt by rent, they get hurt by high gas prices, hurt by high food prices. And so a lot of times these PCE numbers, they don't really capture that sentiment and what's going on and that demand destruction that's occurring, which ultimately causes recession.
That's really interesting because a few months ago, that demographic was what was driving consumer spending, the higher end and the luxury purchases, et cetera. And to find out there's a shift in that is telling, holy smokes. But also, I'd be curious.
It is because I was
Yes,
gonna say, maybe it's because all the mortgage professionals are in that high-end group, and
yeah,
they've all cut back their
we've all
spending
stopped
suddenly.
spending, right? Exactly.
Yes, they are wise to do so. I did a video like 4 months ago. I'm like, just take my advice from 2007. You're like, my dad said you didn't make the wave, but you look good riding it. I'm like, save your money. Like, and I even said something, don't go buy that expensive car, which was
Right.
the $1,000 car payment.
Yeah,
Because it, who knows? I mean, this thing could last a year or two. You don't know. Like, none of us know.
right.
Yep.
Well, I thought it was interesting. Incomes are up by 0.5%, but spending is up 0.2%, which is half of what they expected. They expected it to be up 0.4%, but they lowered the revisions for last month were revised down lower 0.4%. So spending is impacted at this point, and I think that it's going to continue to end up. It's going to continue to move in that direction, don't you?
Yeah, amen. I mean, that's the trend right now. Don't fight the trend. And I love how you have all the data like in a nice, concise, written down manner. I just digest it as it comes in, and then I do a video on LinkedIn, and I just forget about it until someone reminds me, like you, like oh yeah, I remember reading that.
Yeah, well, I write it down because again, I feel like
17 tequila shots later.
okay, I will say I know tequila. I literally, you should have seen, and man, they were all about tequila shots, obviously. I mean, you walk into a store, they're offering you tequila shots, and I'm like, you want me wasted so that I buy some of your junk. I was gonna say some other word. I caught myself. I'm very proud. Anyway, that being said, let's talk about fintech for a moment, Kevin Peranio, because I'm curious about what you think is happening in that segment.
Well, I am able to handle this question because I was a good boy yesterday. I only had one tequila shot at 5:30 p.m. and then I did my LinkedIn video, and literally that was it. It was a school night, so I was a good boy, and I normally don't I normally don't drink before I do my videos, but one shot after eating Del Taco, no big deal.
It's
but
like Kevin counting tower cranes in Dublin after going on the Guinness tour. So,
Yeah.
I'm definitely gonna go watch your video now. I want to see how that looks. So anyway, all right.
as a fellow Kevin, I am jealous that you are in Dublin. So I've yet to make my way outside of London. So I want to get back there to Ireland and Scotland and all that stuff. So I'm very jealous.
And by the way, they celebrate the 4th of July. The streets are all red, white, and blue flags and Statue of Liberty all over the place. It was like, holy moly. When you get to England and like, what's with you guys?
Yeah, they don't.
I know what's with them. They lost us. So
do they also paint their faces blue and wear kilts and carry spears? Anyway, I digress. Best movie ever.
Okay. All right. Focus,
fintech.
people.
Fintech. Okay. So, well, what's interesting is the mind that creates fintech, the brain that creates fintech. This friend of mine, Ali, he said something really funny. He was wearing like a suit and tie and like wingtips and and this guy who's like a technology guy, was wearing his typical, sport coat or t-shirt, like Steve Jobs wore the same, black turtleneck every day, whatever. And so there's a spectrum, right? There's the services people and then there's the technology people, right? And so what's interesting about the minds is that they're totally different, right? Like we're mostly services people in our business, right? And Wall Street pretty much hates us because they're like, you're only tied to the Fed funds rate, and if rates go up, you guys aren't doing as much, and if rates go down, you're doing a lot more, and so they reward the stocks either way, right? And so we're here to serve people. We're servants, and a lot of our output is based on some macro components that we don't control, and then our own personal effort within that macro environment. Fintech is looked at as like this breakthrough, deflationary, cut through all the morass type solution to the same business problem. The problem is we're in a people business. So, there are only, again, I'm not saying fintech won't continue to break through our business, because it will. And what it does is, in my opinion, I try and dance that line right in the middle, be like the best of both tech and services people. It enables our people to do more in a more efficient manner. And you still have, you still have to have some kind of communication, right? That's humanistic, especially for a first-time home buyer. So what I would say with fintech, where it was very successful the last couple of years was the easy peasy cookie cutter, refi loans. Well, 70 to 80% of those are gone, maybe more, depending on your business model. They're just not there. And so you're back to like, okay, how do I solve this solution? How do I help this borrower that has an ITIN number get into a home? How do I help this minority, that's in a certain segment that maybe I wasn't reaching out to the last 2 years because I was focused on, high-end, easy refis? How do I help this person? How do I even find them intentionally? And then, maybe particularly, regardless of someone's demographic, I'm finding more and more people with poor credit profiles. How do I help them build that credit profile, teach them financial literacy in the community, help them get better, get in shape to be able to buy a home, which is a privilege, and use our expertise to do more of that, which, by the way, so basically what I say is, we're working twice as hard for, half the output or half as much money. And that's okay. That's just part of the cycle. We're building, our book of business for the future refinances later. So where does fintech fit in right now? I think it's a lot of the processes that are complicated. I got with this group approached me when I was in Nashville a few weeks ago with like a better version of a QR code or a banner you could tap on a website that pulls someone's cell phone data immediately, 140 pieces of data into like opt-in text at the borrower's tap, one tap, boom, done. And now it's in my CRM and the borrower opted in. So like things like that, that help you just cut through the friction, like an Uber or Lyft style, manner of helping consumers, get into a home more easily. So, that's where fintech, in my opinion, fits in, nowadays. And but at the end of the day, it's still a services people business that we're trying to grind and help put people into houses.
So that really is the question for me, right? So you've had, even during the heyday, right? Everyone's refinancing their brains out. You've got these call centers, you've got these drones who are like, with the borrower saying, I want this, and them going, okay, bing, 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 here's your rate. That's all they cared about, right? How much did those people miss out on because they didn't have an actual professional who could help them with a strategy? How all those people who are so proud of themselves because they think they saved an eighth or whatever on rate. Oh, look at my rate. Yeah, you just did a rate term refinance, but what if you had done X, Y, and Z instead because you had an actual mortgage professional who knew what the heck they were doing and was looking at your overall picture and figuring out, but if you did this, you would save $4,000 a month instead of $1,500 a month or whatever, right? So we'll never know the answer to that, but I think that we need to really be actively promoting that idea to the world, which is you got to have a good strategy that only comes when you're working with a professional. And if you're working with a local
professional, a local originator and realtor, the local part is the part that's key.
If you're working with some ding dong in a call center, which frankly, most of us would say we're at least, nobody who's been in the business 35 years is working in a call center, right? Nobody who knows really the ins and outs of how to originate a loan and figure out, oh, that didn't work. I have 4 other ways to try right here without even thinking about it. Let's look at one of those, right? So anyway, I think
local originators aren't the ones being fired in the headlines.
Correct.
That's right. The value comes at the local level from the professionals that know what they're doing, and their time is worth it. Sandra was asking what CRM we're using. That's the fun question in the industry is what's the best CRM out there, and then the answer is always the one you use. But we use both Surefire, Top of Mind, and Total Expert is our main one. We have over 1,000 LOs on that. So, but then then there are the LOs that have, the ones for the prospecting part of the sales funnel. There's a lot of little ones out there that people use up funnel. So they're using 2. So, you just got to find the one that works best for you and your team and your LOS.
Yep. I will say, so let's just segue into FGMC's bankruptcy, shall we? So we have a robust, to put it mildly, business for the last few years. And we are 6 months almost, not even, into, oh God, what the heck? And we've got a place going bankrupt already. So how does that happen? Like, what happened?
Yeah, here, this is my personal take. So I'm not representing, anything or anyone other than just my own thoughts. And I'll try and say it in a manner where I think is like,
That you won't have everyone
keep it.
mad at you? Go ahead. Try.
No, I'll leave that to you. No, just kidding. No, here's again, I haven't actually spoken. I don't know the ownership or leadership at either FGM MC. I believe Aaron Samples is the CEO. I've never met him. I've heard his name out in all the articles for years, and I actually don't know the people at PIMCO. Well, first of all, PIMCO is enormous. It was created by Bill Gross and Muhammad Al Arian many years ago. But I think there was like a growth fund. There was a fund within. I mean, PIMCO is enormous, right? And so there's a fund within PIMCO that invests in companies and tries to grow them. Now, pre-pandemic, PIMCO was purchasing at any given month as much as 90% of all the non-QM paper. So they're like, hey, we're buying all this stuff from, yeah, it's crazy. So like when Angel Oak or Sprout or all these companies would, Citadel and all that, when they would package this stuff up and sell it, PIMCO was a big buyer of it.
Wow.
And I know Goldman was a buyer and all these, you buy mortgage-backed securities in the private label security market with a high yield. It's great, right? And so I think the decision a couple of years ago is we might as well stand up this company, FGMC, First Guarantee Mortgage Company, to be a front-end facing originator of the paper that we're already buying. Right. Now, they had this product called the Maverick, which is like their key product. We looked at it. It's a great product. But what's interesting is the paper that PIMCO bought behind the scenes had a wider and deeper, even more risky credit profile than what First Guarantee actually put out. And so I know some of the AEs and some of the heads of sales and their ex-COO. Like I know a lot of I know pretty much everyone except like their CEO over there. And great crew, awesome people, fantastically run business. But what happened is that the non-QM market has faced, we've all seen it, a few really rapid disruptions just this year. We saw in March of 20, like it pretty much evaporated overnight, right? It just kind of ended. So the Dodd-Frank Act, created, this is a qualified mortgage, pretty much anything that Fannie, Freddie, or Ginnie will do that you can run through D or LP. And this is a non-qualified mortgage. So the non-qualified mortgage was kind of like what we called the old subprime loans prior to the crash, the 2008 crash, the Great Recession. So these loans are not sold on the secondary market like Fannie and Freddie and Ginnie loans are. They're sold in the private label market. And so it's a small segment of the market, and it's just the appetite of whoever the private label buyers of that paper are at that moment. And sometimes because there's so few buyers of it, they just go, you know what? We don't like the fact that there's all this stuff that you created at 4.5%, 5.5%, and now the going rate in the market is 7, 7.5%, 8%. We're just going to sit back. We're not going to buy this from you. Right. And so these companies, like FGMC, if they rely on the liquidity of doing all these loans, taking it at a certain rate, paying money out for it to the origination channel, then turn around and selling it to the market, and the market's not there, the buyers are not there, what do? Do they hold it? Right. Do they have the capacity and liquidity to hold it? Or do they just sell it at a loss? Do they hold it until maybe the prices come back around? I mean, they don't know when rates will come back down and people will want to buy. When rates go up, I mean, the appetite in the secondary market to buy loans at a lower rate, especially for non-QM where it's not as liquid, it's not as big, it literally just evaporates. And so my understanding is that PIMCO in March said, hey, you know what? We no longer want to back this venture. And so again, I can't speak on behalf of the leadership. I don't even know who the leadership is that makes the decisions at FGMC. But I know that if I was there, I'd be like, okay, PIMCO, you don't want to buy our stuff anymore. We're not just going to shut down tomorrow or start winding down. We're going to keep going. The non-QM market is still a viable market. We're going to go out and try and secure more funding or financing. And apparently they were unable to do so. And then the market just kept getting worse and worse under their feet. And so at one point you get to a point where you're like, we don't have the liquidity to keep the doors open. So, you know, that's
Wow.
that's a macro trend that you don't control. And, you know, my guess is that from the time PIMCO alerted ownership and senior management at FGMC in March, they were scrambling to try and make things work, which you can't fault them for that. I mean,
Right.
in March, do you think they wanted to go to their own people and go, you know what, we're going to cut half of you today to make sure
Right.
we have the liquidity stay in business tomorrow? That's a tough decision to make, especially when you look all around you and you see other lenders like Angel Oak and Accra and Deep Haven and all these players that are surviving through the exact same macro trends. So again, I can't speak for what the decisions and what were going on behind the scenes, but from my outside perspective, you know, that's generally what was going on. And again, I mean, you know, we've done our part in this community that we've all built together. We've hired a couple great people, and there are a lot of great people at FGMC.
Right.
You know, and we're trying to help, you know, because we're still in growth mode. You know, we need a couple developers and some, you know, marketing people, and we're trying to do our thing. And so if you looked on LinkedIn, there's some great chat going on, like trying to help people out. But, you know, sometimes these things, you know, it's like, I don't know what can be controlled and what can't, you know, on a company by company basis. You know, it's just hard to see out there. That's, you know, we're so conservative, you know, we're just like, you know, we're going to make money. We're going to do mostly A paper, which is a liquid market. And, you know, we feel that some of those asset classes like non-QM loans, they are risky.
Okay. So I'm going to take my simple little brain and just break it down into very simple little explanation, which I think I gleaned from what you said. We had rates a few months ago at, you know, in the 4 to 5 rate, right? Good God, I still can't think. Anyway, rates between 4 and 5%, maybe even a little lower on non-QM. And all of a sudden now we're at at a market where they're at 7%, maybe even higher, whatever. And they can't unload those old loans that they've already closed or that they had committed to. So then, and if there's no liquidity, then they're sunk. I mean, that's kind of it, right?
I mean, the secondary market, I say this all the time, and you are free to steal it, is cold, heartless, and unforgiving.
Right.
And let's think like these big hedge funds think.
Yeah.
If there's just a few people that control the market, they could be like, you know what, we'll pull out. We are on a buyer strike. We're not going to buy. We'll let you suffer. Let's see if you can last long enough. And then we'll come back and buy the exact same paper for a 10% discount from you, maybe a 20% discount from you. You know, I mean, you know, you get that. That's why, like, I just, it's just my opinion, and I'm not trying to paint with a broad stroke. But it just,
it totally makes sense, KP. It totally makes sense. Hello. I mean, it should have occurred to me before I asked the question. So thank you. Appreciate it. Okay, just wanted to, in other news.
Before you go on, I've also noticed that when other companies, like one we particularly happen to know really closely, when they seem to want to do correspondent non-QM lending, that usually is a sign it's the end of the non-QM market. I've seen it happen twice in the cycle, and it's like as soon as they start pushing to non-QM stuff and how almost invariably within months that market just dies.
Good God, I hope that's not going to happen.
It's happened twice now. So,
well, you know, I don't know if that's as solid a theory as the crane theory, but I do agree that you know, when you start to open, but when you start to open up, you know, like, let's do more non-QM. Let's make it even easier to facilitate this. Let's bank more of it in-house. Again, I think it's you have to pick and choose your partners, right? And so let's just say that you know, let's say that, you know, the leadership at FGMC, they picked PIMCO as their partner to do correspondent together with them. And then PIMCO just said, you know, hey, we're out on this. And for whatever reason, I don't know that reason.
Right. But again, you've got, if you just look at the rates, we want to sell you, you know, an investment that's going to yield 4%, and the market is now at 7%. Okay, it's a no-brainer, right?
Yeah, I mean, that's part of it, but remember, you know, it's just, you know, when you get these people that are trained, you know, in Wall Street and these VC firms, you know, they're trained to make money.
Yeah.
and they're opportunistic, and an opportunity to say, you know what, if we just simply stop buying for a little bit, we could buy the same asset for a little bit better price here shortly. And if someone goes out of business, and then we'll just it'll be an even bigger fire sale. So that's just kind of again, the secondary market is cold, heartless, and unforgiving, and it is unfortunately not something that we can control, not even the great folks at FGMC, unfortunately, sadly.
Yeah, I know. Again, I don't think anyone well, nobody should be celebrating when we're seeing places go down. It's not good for our industry to have people going out of business and having people not having jobs. That's sad. And I always have Brenda Cantu's voice in my head anytime I used to be like, all right, recession, yay, we're getting low rates. And she's like, don't forget what happens to people in recessions. They get hurt, they lose their jobs. It's all bad. And I'm like, okay. So I now have Brenda's voice reminding me too.
And it's true. And if there is a silver lining, and I hate to say it, it's like, because we're very philosophically aligned, but Dodd-Frank worked.
It did.
So it I said this 2 years ago, I've said it all year, and then here's another example. If these products, these non-QM products, which were prior, called subprime, and again, I don't know exactly the product mix at FGMC,
right.
In particular, but just in general, you can get a non-QM loan. If you put enough money down, you can be one day out of bankruptcy or one day out of foreclosure.
Right.
And if you're going into a recession, that borrower might be, they've already shown that they're not willing to make good on their payments. And so, even non-QM loans, you aren't in the business of doing a loan that you have to foreclose on just because there's equity. It's still very expensive. But my point is, if those loans were commingled with Fannie Mae, Freddie Mac, Ginnie Mae loans, which they were prior to the 2008, prior to the Great Recession, it reverberated to the rest of the industry. And so now it's a self-contained unit. Non-QM is carved out and it's over here. And when that has a problem, like we're seeing from time to time, the integrity of the rest of the system, the bulk of the system, remains intact, and we keep moving forward. And so, I would say, for what it's worth, Dodd-Frank worked there, and the rest of the system just keeps on moving forward, and we don't have a massive contagion or credit crisis.
Okay, first of all, I thought we had covered the fact that we do not refer to it as the Great Recession. It was not great. It sucked. And there are a myriad of other words that we could be using, and I would suggest you find one and stick to it, because
you tell me.
I don't care. I'm putting you in timeout next time you say Great Recession. Jeez Louise.
Hey, they call it the GFC. They call it the GFC in London, where Kevin's at, the Great Financial Crisis. They call it the GFC.
See, again, the word great is completely out of place. We are not calling it great. It is not great. Okay, moving right
Massive.
along. I would the big, huge cluster. Anyway, BHC. I think we might have something there. Big, huge cluster. Anyway, but I also want to remind you that because of Dodd-Frank, even non-QM loans have the ATR of some sort. You still have to show the ability to repay. Don't forget that. So
yeah,
those loans have performed really well historically. So we'll see if what happens going forward. I need to find out what's current with that, because I haven't gotten that number lately. Those loans have performed, really, really well. So
agreed.
Really subprime, right? They're not really people who are just like total losers. These are people who just don't fit into that stupid little box that's been created at the conventional level. Okay, very quickly, because we are almost out of time, for God's sake. Number one, wanted to say that median home price across the nationally is now at $450,000. It is up 16.9% year over year. It is up 38.5% from June 2019. That's a big number, 38.5% for the median home price. And I know the median home price is kind of a crap number, but still. Also interesting, because this is an important one for all of us. We're seeing these big, huge headlines that talk about how inventories are so elevated, et cetera, et cetera. Listen to this. So yes, they are up 18.7% year over year in June. It's the fastest ever recorded pace. However, guess what? They are 53.2% below June 2019 levels. Suck on that for a minute. Do you really, and so there's always this time of year where, of course, the inventory levels go up right? Because it's that time of year, and then they, you know, go back down to normal. But we are currently 53.2% below June 2019 levels. I just found that fascinating.
Yes.
Okay. Being almost out of time, I just briefly wanted to talk about the Fed comments with Jerome Powell and the G7 leaders, where he said, and I quote, "We now understand how little we understand." Are you freaking kidding me? This is our Fed chair. We now
Is that
understand
official
how
statement?
little we understand. Now, I appreciate someone who will admit what they don't know. I love that. Tell me that you got it wrong. I'm all good with that. But they have not said, "Oh, we completely blew the pooch on this." They're still saying it was supply chain and the war. That's what did it. No, that's not what did it, buddy. We just got, I mean, the war happened in March. Really? I mean,
Yeah.
so
Don't forget, it is a midterm year, and so you know there's some things they have to say. Like every time I hear, just kind of like one of like the little dog whistles out there is every time you hear the war in Ukraine, like if that's like the lead in, it's basically they're making an excuse
Yes.
for
Yes.
falling asleep at the wheel, right?
Yes.
So
And kind of over supply chain too. I'm like, really? Okay, that's
yeah,
it.
I mean, you know, the war's still going, and you know, the price of oil has come down 20% in like 2 days. So you know, it is volatile, right? But where the Fed missed is they were waiting for data to come out and confirm inflation, but their definition of inflation was very self-serving. And this is what, you know, I think it was a meeting in like January or February, and Jerome Powell basically said, anything not permanent. Okay, so that was that was how they defined transitory. That was the words came out of his mouth. So that means at some point in the future, inflation will go down. That was their thought, and that
really,
that was where they. Yeah, I mean, that doesn't help, you know, me with how expensive food is or gas. I just filled up a truck yesterday, and the stupid gas station topped out at $200, and I wasn't even done filling it up. You know, so you know it's terrible. So you know it's like, so they define transitory as anything not permanent, and that doesn't help us. That doesn't help. Everyone has to pay for it, and so they were willing to let it run, and they didn't really have like okay, we're gonna get to this point and then start dialing it back. They were late to the game, and that's the problem. And so here we are trying to slam on the brakes with, you know, 375 basis point rate hikes in a row in the face of slowing growth, no growth, negative growth, and persistent inflation, even if it has peaked. And so, yeah, I mean, you know, they have blunt tools there. That's it. The money supply is shrinking.
Yeah.
The money supply is absolutely shrinking, and rates are going up. So we'll see what it cracks here between now and the end of the year.
Just to recap, because you just can't like digest this well enough. We now understand how little we understand. All right, with that, we are going to wrap it up, and we are going to talk for just 1 second about the fact that next week, Tuesday, the 12th, we have Dave Luna joining us. The week after that, Megan Anderson with MBS Hideaway. Week after that, Dr. Elliot Eisenberg, our favorite economist. Week after that, yeah, folks, I've been busy. We have speakers scheduled. Bill Lohman. After that, Rob Chrisman, Josh Pitts, Aaron Lee, who is the COO of Loan People. And then on August 30th, we have Mark McArdle with the CFPB. He actually seems, guys, like a very interesting, cool guy. So we have a lot to look forward to, but we want to take a moment and thank you, Kevin Peranio. We love you very much. It's always entertaining when you're here. We really appreciate it. And
thank you.
I'm going to go sing the Star Spangled Banner right now because your shirt has really inspired me.
Hey, what a great group of speakers. I know pretty much all of them personally, and that means I'll see y'all in the fall.
Yeah, you're in good company, KP. You're in good company. So with that, have a wonderful week. You see a rate you like, lock it in. And next week, God willing, KC will be back in the USA. I will be in the USA.
I hope so.
Yeah, so we'll see how that goes. Kevin Peranio, thank you very much from the bottom of our hearts. Have a wonderful week, everyone.
Cheers. Safe travels.
Thank you, guys.
Bye.